My name is Jeremy Kasdan, Sales and Partnerships Lead at FinTech TV, and Taking Stock starts now.
Two minutes to go into the close. The major market indexes currently off their session lows as we inch closer and closer to the closing auction here on Wall Street today, but still a negative print on this Thursday, April 23rd, with the S&P 500 expected to finish in negative territory, down about 0.4%, a 1.4% peak to trough swing for the benchmark index today after the S&P and its pals here, the Dow, the small caps, they had all been positive early in the session. Some mixed messaging over the timeline and expectations for the ongoing conflict in the Middle East, kind of roiling investor sentiment in the afternoon session. A steepening of the yield curve as well. We did see utilities, industrials, and consumer staples outperform the broader S&P 500 and your S&P laggers on the day, including tech, discretionary, and financials. That much more sets the stage for this afternoon's broadcast. And welcome to the show. You're watching Taking Stock. I'm your host today, J.D. Durkin, just a few moments away from the ringing of the iconic closing bell down here on the trading floor of the New York Stock Exchange. We got the team from Neuberger on deck. They are set to do the honors here on the broadcast. The Magnificent Seven tech stocks, not a great tape today, if I'm being honest. Shares of Microsoft most under pressure, down at this hour about 4%, and down year to date about 15%. Caterpillar, Verizon, Coca-Cola, those are the outperformers for the Dow 30 or Dow laggard, Salesforce, IBM, and Amex. Time now for the closing bell. Todd, that's how you hit the sounding block, by the way. You do it with some oomph and authority. All right, your final tale of the tape on this Friday Eve. The S&P 500 down 0.4%, the Dow 30 down 0.4, the New York Stock Exchange Composite Index selling off 0.2%, and the small caps down 0.4 as well. A whole lot of big, ugly red candlesticks across the tape today. Fintech stocks affirm the hardest hit name in that sector. Software stocks led down by Salesforce in the Dow as well. The auto stocks led down by Rivian, having a terrible tape today, down about 14%. The airlines, though, surprisingly resilient. JetBlue finishing up about 2% on the day, but a mixed bag overall. Let's bring in our first guest of the broadcast, the man himself, the great Eric Criscolo. He is market strategist at the New York Stock Exchange. My man, thank you for joining us as always.
Always a pleasure.
Let's talk correlations. Oil moving up. Wow, look at Brent, almost back up to 106 on the day. Stocks moving lower. What'd you see for today's tape?
Yeah, I mean, it's more of the same, right? Oil is higher, or at least not moving lower, right? So that just continues to weigh on the market in general. You're seeing interest rates continue to stay elevated. They're not really making any move lower. They've been range bound for a while. They're kind of ticking up now again. Gold is falling. They're kind of moving in reverse, right? Oil rates higher, gold lower. And then that is just weighing on some of the risk assets as well. You saw outperformance in the defensive sectors today. So consumer staples, et cetera. So those names, that kind of dynamic is playing out, at least for today.
Yeah, we saw Coca-Cola, for instance. That to
Right.
me is the ultimate defensive. How does it perform in the Dow 30 relative to the benchmark indexes? When Coca-Cola's up, it can be a little bit of trouble for the broader equities
Warren
on a day
Buffett's
like
happy.
today. Warren Buffett's, yeah, the Berkshire crowd is happy for sure. Software, man, ServiceNow, IBM earnings, both down after earnings. Maybe it's muted guidance. It's not really the numbers of the last quarter. It's about what you project moving forward. Are we back in this narrative of AI concerns shaking up those core products?
You're still seeing a lot of uncertainty. I mean, the reports weren't bad. The CEOs were generally optimistic. But I think you're just seeing investors just not know how to value these things going forward. There's some concern about pricing, right? How do they price their products going forward? Is that going to hit margins? Even if the total pie increases, are margins lower? I don't have the answers to that, but that's kind of the questions that are happening right now. Plus, you also saw software had a rocket move higher last week. So some of this move today is also some of that froth coming down a little bit as well.
I want to ask you about semiconductors. Todd, if you can get a shot here on my screen. This is the semiconductor. I mean, look at this chart. It looks near parabolic. This is SOXX. That's one of the many semiconductor ETFs. These things have been ripping. What do you see on the semi trade as of late?
Software was kind of taking back some of that froth from investors, last week. but still. These guys are still printing, crazy numbers. You had semis report today, even like the non-AI companies, some of the semi-power companies, right? The ones that make the non-AI power chips, those names reported well. So that whole sector is just seeing a huge demand that is, even if they're not, beating the numbers like they used to be, they're still putting up impressive results. And so that's just keeping a bid in that whole sector.
Dare I ask you about ticker symbol CAR?
Car crash.
You knew exactly what I was going for people who have not been following the wild story over Avis Budget. Down another 48%. It sold off yesterday, 38. You got the hedge funds that control 70% of the shares. The short sellers are very loud here. You've done this a long time. What do you think when you see a story like that?
Yeah, I mean, it's one of these crazy things that happen every now and then in markets. It was a very mechanical thing that happened. Giant short squeeze. Eventually, those things can't run forever. Eventually, positions have to be covered. Eventually, the people that are holding the stock want to get out as well to monetize what they've gained. So once those things kind of flip, you see, everything rips higher, and then everything kind of crashes lower. And that's kind of the dynamic that's playing out right now. Fortunately, that doesn't happen a lot, but that is just what's happening in that name in particular. But it did impact the Dow Jones Transportation Average, which had an incredible run because basically of that one name.
Yeah, which is, of course, price weighted.
Yes.
And so when you get this anomalous move in the stock, it automatically kind of becomes the most weighted name, more than FedEx, et cetera. I hope you come back and see us next week. Man, we got earnings on tap from big tech names.
Big names.
Powell on Wednesday. It's Fed Day. Dude, this is the stuff.
Crazy
we love
week.
Weeks like this. Eric Criscolo, thanks for kicking us off, brother.
Always a pleasure. Thank you.
Grab your mic. Ty will head this way. We'll bring you the biggest analyst calls on the day that moved the tape today. First up, BofA reiterating Tesla as a buy after earnings, saying they expect it to quickly become a leader specifically in robo-taxi services. Shares of Tesla down about 17% on the year. Next up, UBS reiterating Berkshire Hathaway, we were just talking about it, as a buy, lifting its price target to $581. Berkshire is down about 6% on the year. And finally, hello everyone, HSBC initiating coverage on Oklo as a buy. Those analysts say the nuclear company is, quote, firing on all cylinders. Shares of Oklo up about 3% since the start of 2026. And Ty, let's take a look at one notable that did not have a particularly notable day. It is, of course, IBM, down 8%. But BofA did reiterate the stock as a buy this morning, citing plenty of positives, they say, after quarterly results last week. That includes a solid balance sheet and relatively stable margins. Shares of IBM down 8% on the day and down 23% since the start of 2026. The New York Stock Exchange's own Ashley Mastronardi caught up with Miso Robotics CEO Rich Hull here at the New York Stock Exchange to discuss their Flippy Robots NBA Arena debut and much more. Take a look.
Miso Robotics has been making news with its recent acquisition of operations app Signal and its collaborations with tech giant NVIDIA and NYSE-listed Ecolab. However, it is probably best known for something else, Flippy, its AI-powered robotic kitchen assistant that can serve up French fries, chicken tenders, and onion rings. Joining me now is Rich Hull. He is Miso Robotics CEO. Rich, welcome.
Thanks for having
to the
me,
New York
Ashley.
Stock Exchange.
It's exciting to be here.
So Flippy just cooked its 5 million basket, and he's now working in his first NBA arena. What milestone does this prove about AI in kitchens?
There are a lot of milestones about AI and robots in kitchens, that's for sure. So you're right, we're celebrating the NBA playoffs with our entry into our first NBA stadium. Flippy's traditionally been known for his work in fast food restaurants, and so going into a stadium is a little bit of a different use case. There's a lot of peaks and valleys in a restaurant when it comes to demand and rush periods, but on the other hand, NBA stadiums, everybody wants to eat at halftime.
All right, and you mentioned that it's a little bit different being in an NBA stadium versus like a fast food restaurant. What are the main differences?
Well, they all deal with labor shortages and rising labor costs. And so what Flippy allows you to do is to redeploy the labor that you can hire. It reduces injuries, it increases throughput because Flippy works twice as fast as a human. It reduces food waste. So all of those are consistent across restaurants and NBA stadiums. But at NBA stadiums, there's these massive rushes, and then you're down for a day or two, and then there may be a K-pop concert or some other event. And so it's really lumpy. It's up and down. But this is a big experiment for us to see how Flippy does and to learn a lot. And we think that the stadiums and the theme parks and even college campuses are a really massive market for us.
How has Flippy been keeping up with the increased demand?
It's been great. He cooks an average of 50 pounds an hour at this particular NBA stadium, and he's doing great.
All right, and you recently acquired Signal. How does that AI operations tech fit into your broader restaurant strategy?
What we're doing is we're building a platform that powers the modern restaurant. And restaurants are really desperate to modernize. Much of that is driven by labor challenges. And most of that was exposed during the pandemic. If you remember, during the pandemic, there was a lot of publicity around restaurants having a hard time hiring enough staff. And that really became a permanent problem. So Flippy does all of that. And then by acquiring Signal, we combine that with our product called Zippy. So Flippy and Zippy, you get the gist of how we name things here. And so Zippy is a restaurant operations product. It also allows employees to sell more. And so now all of our products start to talk to each other and communicate seamlessly. And that's really what a modern restaurant looks like.
What does Zippy do specifically again?
So it ingests all the data that one needs to run their restaurant, from the point of sale, labor scheduling, payroll, and then provides that in real-time dashboards, and then adds an AI intelligence layer that gives general managers and owners real-time advice about what to do. And if you're running 1 or 2 restaurants, you can typically do that from a spreadsheet, but try doing it with 50, and you're much better to run that with some type of tool.
And I understand you serve brands like Jersey Mike's and Cinnabon. What are they using the technology for the most?
It's a combination of the AI and the robots. And so we make specialized robots for, very complex, pretty harsh, even regulated environments. And so what they're using it for is to improve their efficiency. If if you're really doing restaurants well, it is a high single-digit profit margin business. And if you add labor challenges, tariffs, rising costs, that starts to whittle down your profit margin. And so what we do is we allow restaurants to expand that back up by driving more efficiency through our platform and ultimately the products that communicate on our platform.
All right, and you have collaborations with Ecolab and NVIDIA. How are they impacting what you can deliver to restaurants?
Ecolab is a strategic investor for us, and they've been an excellent partner. They're a 100-year-old Fortune 100 company, and they really want to figure out ways to support modernization in restaurants. And so they've done that with us, and they are a great collaboration partner. With NVIDIA, we get access to much of their early technology, and we were the first to commercialize it in the restaurant space. And so we collaborate back and forth. We give them some guidance. They give us some guidance. They have some great AI technology that we wouldn't normally have access to, and that accelerates Flippy's work and our growth as a growth stage company.
All right, Rich Hull, Miso Robotics CEO, thank you for joining us on NYSE Live.
Thanks for having me.
Welcome back to the show. Parker Graham joins us now. He is the founder and CEO of Vestibule, a sports investment platform where fans, or honestly investors, can put money into athletes or teams. Parker, it's nice to have you here. So talk to me about investing in specifically mid-market football clubs across Europe. How do you make that process more accessible to retail investors?
Yeah, JD, it's really the best part of the market right now, in my opinion. You see so much private equity money is going into sports, whether it's here in the States or in Europe, and it's really focused and concentrated at the top leagues, right? Think La Liga, the English Premier League, and it's left this giant opportunity in the middle market with tier 2, tier 3 teams in multiple countries that if they just had the right capital infrastructure, you'd be able to make a lot of money and a lot of returns for investors. Today, there's just not really a whole lot of access points to get money into those markets. And so we saw this massive opportunity for Vestibule to be the market maker in those spaces, bring the capital from not only just retail, but also institutional buyers as well, and create an ecosystem where anyone can participate in sports ownership across the globe.
Seems like you got some big name athletes helping you, at least on the investment side. What more could you tell us there, and how do those relationships come about?
JD, being a former pro athlete myself, I've got access to incredible investors that played in the NFL, the NBA, and the MLB, and really across the entire stack. And when I started talking about what we were building at Vestibule and this whole idea about earning equity and building equity versus just being a player, it really spoke to the athletes that I've got in my network, excuse me. And again, once I start telling that story, one person tells another person, and we actually just launched and revealed our first two athletes that have joined us as big key pillar investors into KSV. And that is both Trey Boston and Jay Jackson. We've got a lot more behind them. And not only this deal, but every deal that we have on deck for this year.
Sports wagering is everywhere, not to mention the role of prediction markets aside from traditional sports gambling. How do you compete for the attention of fans?
The good thing about sports investing from my perspective is that, a lot of people lose quite a bit. That's kind of how those businesses are built. And everyone's experienced that parlay that didn't work out, or that investment, or that bet that just didn't really go your way. And I think the more people that experience that, the more likely they are to try investing. A lot of individuals in America are investing. They have a 401k, they have an IRA, and we're really trying to bridge that gap of you can have just as much, short-term gratification doing things on the investment front as you can, and gambling with your buddies on Saturday.
I got about 30 seconds left. How does regulation impact your would-be ability to scale globally?
That's a great question, a very loaded question, JD. But I think for us, we're very blessed in the sense that the regulation that we use, which is Regulation A here in the U.S., is a really, really broad-based, gives us a really broad-based ability to work with all kinds of clubs across the world, especially when we're focused here with U.S.-based investors and folks that just really haven't had access to invest in these assets all over the world. As regulations continue to change, we'll continue to move with them. And I think, honestly, this is really the first phase of our company. I think you'll see us go from our current regulation and then possibly getting into different ones so we can grow the company to be as big as possible, maybe even as big as the New York Stock Exchange one day.
Parker, I know you are as excited as I am for tonight's NFL draft. We'll have to link up after and see how things fall. Parker Graham, founder and CEO of Vestibule, my man. You're welcome back anytime. Woo! Nice to see you. Don't go anywhere. A lot more Taking Stock coming up after this. Welcome back. FinTech TV's very own Johnny Fernandez sat down with Jaspreet Randhawa of Birkin World Investments, and they discussed Abu Dhabi's resilience amid the ongoing U.S.-Iran conflict. Take a look.
Welcome to FinTech TV. I'm Johnny Fernandez. And while headlines focus on the conflict, money is still moving in Abu Dhabi and in the Middle East. Now, here to break down how Abu Dhabi's economy is staying strong is Jaspreet Randhawa, Head of Investments and CIO for Birkin World Investments, a global investment firm headed in the UAE. So to start off, you are an American working and living in Abu Dhabi at one of the most turbulent moments the region has seen in years. Personally, has this moment changed how you see the region, and what are you hearing from Americans and investors, and is this shifting their view?
Absolutely. First of all, a good evening from Abu Dhabi, and thank you for having me here. And yeah, this is a question almost everyone is asking that what has changed there? How do you see Abu Dhabi? And honestly, when I look at what's happened here in the last little while, it's what's staying with me is not the presence of tension, but the absence of disorder. The way Abu Dhabi has handled this crisis is absolutely incredible. And obviously, it's not something uh, that just happened. It's something that they had prepared for a very, very long time. And I think that's where the leadership has played a tremendous role. In terms of investments, uh, everything is absolutely status quo.
Some international headlines are painting the entire region as unstable and too risky. So someone on the ground like yourself, what is the response to that? And from an investment standpoint, are people pausing, or are some actually seeing this as a buying opportunity?
Yeah, there is a tendency, particularly from afar, to conflate geography with condition. But being here makes one thing very clear. Abu Dhabi is not defined by the volatility around it. It is distinguished by its ability to remain unaffected by it. And I absolutely mean it. The system did not fracture under pressure, and the rhythm of life did not falter. And that reveals something fundamental, not only in terms of life in Abu Dhabi, but even the investment climate and the business in Abu Dhabi. Stability is not a matter of location, it is a function of design. And what you see here is not the absence of external tension, it is a presence of internal strength. And that has made sure that Abu Dhabi, which is actually called the capital of capital, remains the capital of capital. And in the last little while, when headlines are painting that it's not stable here and money is leaving the country and everyone's leaving, it's actually the opposite. We are based in ADGM, which is Abu Dhabi Global Markets. And in the last little while, I've seen more family offices move in. I've seen brand new funds moving in. People want to form funds. There's a massive pipeline in ADGM to do it. So, no, unfortunately, though, it's from far away. It's very easy to just see some headlines and think and feel things are falling apart here. It's actually the complete opposite.
So let's talk about business owners on the ground. How are they navigating this moment? Are they holding steady, expanding, or pulling back?
I would say they're expanding, either holding steady or expanding, depending on the kind of business you're in. But there's nothing. I mean, if I describe the life here, uh, everything is calm, everything is stable. There are moments when there is a siren. Well, at the moment we're in ceasefire, but we would get an alert that there's something incoming, a missile or a drone with payload. Then it was neutralized, or in this case, intercepted, and then life went on as normal. So and it's only at that time when we got the message that we would think of the broader regional context. But without that, you wouldn't even know that something is happening very close to us. And what's really far more telling is the composure and the continuity, a seamless return to normal life right after those alerts. And that is a defining characteristic, not just for living here, but even for if you're doing any kind of business, you want that stability. It's absolutely normal. And to me, true resilience of any place, whether we are living here or you're working here or you're launching a business here, it's not measured by how forcefully a system responds, but how effortlessly it restores equilibrium. And here, equilibrium is not fought for, it is maintained. And I think that's what makes Abu Dhabi such a special place.
That's great to hear. Jaspreet Randhawa, thank you so much for joining us today and taking time out of your busy schedule to join us here on FinTech TV. Thank you.
Money 2020's very own Scarlett Sieber is now back with a whole new edition of Hindsight 2020, where she breaks down important dates in financial history. Take a look.
I'm Scarlett Sieber with Money 2020, and this is Hindsight 2020, the show where history reminds us that some of the most important business decisions don't look bold in the moment, they look boring. Let's rewind about a decade plus. It's 2012. The iPhone, it's everywhere. The iPad still feels magical. Lines wrap around Apple stores on launch day. And Apple is, without question, the most admired tech company on the planet. But there's a debate brewing. Apple is sitting on more than $100 billion in cash, and critics are asking an uncomfortable question. What do you do when you're already too successful? Then Apple answers it. On April 23, 2012, Apple announced it would pay a dividend for the first time since 1995. At the time, some people treated this like a red flag. Dividend from Apple? To critics, this meant Apple had peaked, that it was out of ideas, that returning cash was an admission to slow growth, or that growth was slowing down in some way. In hindsight, that take aged terribly. What actually happened is more interesting. Apple wasn't giving up on growth. It was acknowledging scale. By 2012, Apple had become something bigger than a disruptor. It was a cash-generating machine with margins, loyalty, and pricing power few companies had ever achieved. Paying a dividend wasn't a sign of weakness. It was a declaration that Apple could invest heavily and return capital at the same time. That changed Silicon Valley psychology. Why does this date still matter today? Because April 23, 2012 quietly rewrote the tech playbook. Apple proved that technology companies could evolve into economic institutions, not just innovators chasing the next product, but capital allocators shaping markets. That logic now defines 2026. Apple today is one of the most aggressive capital return companies in history. Its buybacks alone often exceeded market caps of newly public companies. Services revenue has grown into a massive recurring engine, and the dividend that once worried people is now just part of a broader financial discipline. The moat Apple built wasn't just design or engineering. It was ecosystem lock-in, balance sheet strength, and the ability to fund innovation internally forever. Once you reach that position, growth becomes optional. Durability becomes everything, and that's the real lesson of April 23rd. Apple didn't stop being ambitious in 2012. It started playing a longer game. And with that, that is your Hindsight 2020, because sometimes the most powerful move isn't chasing the next thing. It's proving you already won and can fund whatever comes next. If there's another moment in history you want us to rewind, drop it in the comments. Hindsight always has more receipts. In the meantime, back over to you.
Tomorrow on Wall Street, it is Friday. Thank goodness. Earnings from Procter & Gamble, Western Union, and more. Thanks for watching today's edition of Taking Stock. We'll see you again tomorrow.